So hi guys, welcome back. Today we're going to be doing a bit of an informational or explanation video looking at crypto ETFs. So last Friday, the US Securities and Exchange Commission approved a Bitcoin ETF, or more particularly a futures-based exchange-traded fund which is based on Bitcoin. The ProShares Bitcoin Strategy ETF, known by its ticker symbol BITO, has started on Tuesday, the 18th of October. Since then, there have been multiple other ETFs that have also started tracking the price of Bitcoin, and there are set to be ones for other cryptocurrencies as well. Today, we'll be going to be looking specifically at bito, which is the ProShares Bitcoin Strategy ETF, as it is the first and currently the largest crypto ETF on the market. But much of this explanation, looking at the pros and cons, will be similar, as other crypto ETFs will work in a similar fashion as well, with near identical benefits and drawbacks. So today we're going to be looking at two main things. One is how does a crypto ETF work? And two is the pros and cons of investing in a crypto ETF. And we'll be looking at things like market contango and backwardation, and how effectively bito can actually track Bitcoin prices, and whether it's more effective to buy the actual cryptocurrency or actually trade the ETF. And as always, if you find this video beneficial, do consider subscribing. It is free and it does help me out a ton. If not, thanks for watching anyway. On to the video. So what exactly is a crypto ETF? So a standard ETF stands for an exchange-traded fund, and it's often seen as a basket of many companies that hold stocks under their investment. And by buying a single ETF, you could buy a portion from tens to hundreds or thousands of companies within one holding. What's different between a crypto ETF and a standard ETF is that standard ETFs holds the investment within their portfolio, while crypto ETFs kind of work slightly differently. So the main reason is this, that the bito ETF holds Bitcoin future contracts rather than actual physical Bitcoin. And these indexes track the price of one or more digital coins or tokens. This lets investors add up the value of crypto to their portfolio without some of the risks associated with actually owning some of the digital currency, and we'll be looking at the benefits later on. The simplest way for a crypto ETF to track the price of a digital currency is for the ETF company to actually purchase and store the crypto, then divide the shares in the ownership of those coins between the stakeholders. However, the SEC has not validated the actual holding of crypto through ETFs, which is why they've used another model for crypto ETFs to being allowed on the market. And the other model is for the fund to own Bitcoin futures. These contracts allow investors to bet on what they think the price of Bitcoin will fall or rise within a set period of time. And in a kind of a simple explanation, it's estimating the future price of Bitcoin by owning Bitcoin futures rather than physical Bitcoin. While it does have its benefits, there are some drawbacks, and it does expose shareholders to a few issues that wouldn't necessarily pertain to a fund holding the physical asset instead, and we'll be looking on the issues of this later in the video. So the first thing we're going to be looking at is the pros of owning a crypto ETF. So one, an ETF solves some of the security risks associated with Bitcoin. So exchange hacks are not that uncommon in the crypto world, and by owning it in a personal digital wallet, simply hacking a computer system could expose the owner of the Bitcoin to some amount of risk. Of course, lots of good security options exist nowadays, one of which includes cold storage. But even cold storage has some of its disadvantages. For instance, that the connected hard drive where you store your key might break, or the codes that you own on a sheet of paper might get lost. And it's more impractical for heavy traders who might want to be able to sell and buy Bitcoin quickly and more often. ETFs don't solve these security issues totally, but they are more practical and safe than owning Bitcoin in a personal digital wallet at a crypto exchange. Secondly, is that ETFs can be bought from a simple brokerage account. And this is probably one of the biggest benefits by investing in a crypto ETF. When Bitcoin ETFs have become more widespread, investors would be able to simply buy or sell them from their simple brokerage accounts, which most investors already own. This means that you don't need to take any additional action, and you'll be able to purchase and sell Bitcoin more efficiently. This is in contrast to setting up a new account at a crypto exchange through the setting up of a process in Coinbase. Although it's not too complicated, it is still an additional step, and people could find it easier to just invest in an ETF and make it more efficient and more easier for the investor to buy it through a standard brokerage account. The third reason is that expense ratios will go down. So currently, one of the largest Bitcoin traded trust funds is the Grayscale Bitcoin Trust, which has an expense ratio of more than 2%, which is quite high. especially for investors who want to keep their positions for a long amount of time. A 2% annually substantially eats into your profit. And the first US ETF with the symbol of bito by ProShares have an expense ratio of 0.95%. It will invest in Bitcoin futures and will start trading on the 18th or the 19th of October. And because it invests in Bitcoin futures, the price will differ from the Bitcoin spot price. So there is still some differences between investing in an ETF and investing in Bitcoin directly. But when you're looking at expense ratios, and if you really do want to invest on a standard brokerage account, investing in a crypto ETF is arguably a lot cheaper and more efficient than buying the Bitcoin Trust. However, one difference is that the Grayscale Bitcoin Trust does hold actual Bitcoin, it does hold physical Bitcoin stock. The fourth reason is that the introduction of ETFs will add legitimacy and security in cryptocurrency as a whole. So the launch of Bitcoin ETFs means that cryptocurrency will become more and more widespread. More investors are more likely to make it a larger component in their portfolio because it becomes more easy, more safe, and more convenient. And the introduction of ETFs might give a boost to the cryptocurrency morale as a whole. More companies are likely to accept crypto as payments, and more individuals and firms might move some of their assets from fiat currency to cryptocurrency in the short or long term there as well. So there are some benefits, but the next thing we're going to be looking at is some of the harms of investing in crypto ETFs. So one problem is that future markets can often behave in different ways. When the market is in contango, it means that the forward price of the future is higher than the current spot price of the asset. On the other hand, when there's backwardation, it means that the forward price of the future contract is lower than the spot price. So when the market is in contango, it means that the future contracts are trading at a premium comparing to the current spot price, and this can lead to something called contango bleed. Contango bleed is a term for the cost that future ETFs must take on to renew or roll their future contracts. If the price of the future contracts is higher than the expiring contract, the ETFs lose a bit of money on each instance, and over time this adds up. Contango bleed is quite normal and quite large for normal commodities. For instance, a monthly loss of 1% on a natural gas ETF is quite common and not really unheard of, but there are reasons to believe that the situation of Bitcoin can be worse since it is in heavy contango. So analysts like Patrick Hoyser says it could be 5 to 10%, while other analysts could expect it to be as high as 17%, which is quite high when you're looking at contango bleed. On the other hand, the ProShares strategist Simeon Hyman pushed back against the criticism and estimates that the analyzed roll cost will be about 2.5%, which is quite low. Which is quite lower when we're looking at the 5 to 17% range previously expected, but it isn't quite low as you would just get from buying the Bitcoin shares itself, and you will be losing a small amount of the profit that you could make due to contango bleed. Another problem is that bito futures has a market limit. So bito has been quite popular lately, and after only 2 days of trading, they own more than 1,900 front-month contracts. The CME rules define that the maximum number of front-month contracts that an ETF can own is 2,000. And as the newsflash also mentioned, the total number of maximum future contracts that an entity can own is set to 5,000. And bito own 1,900 front-month contracts and 1,400 November contracts. The obvious solution is that the bito would just purchase more long-term contracts, but the problem for this is that the longer term contracts you do, the less effective that they are, that they're going to target a future price. And this will further increase the tracking error of bito versus Bitcoin, as the longer the contract lasts for, the less effective and the less efficient that they will be. And an example can this be seen with USO, which is United States Oil Fund, and they did a similar thing the way bito is doing right now, where they invest in oil futures rather than crypto futures. And in 2017 and coming into at the end of 2016 and coming into early 2017, the price of USO was mostly moving sideways, even as crude oil was climbing from roughly $55 a barrel all the way to $75 a barrel. And depending on entry point, USO shareholders may have experienced no return, even as oil prices were rising. And in 2020 demonstrates an even worse scenario. After oil prices plummeted in the beginning of the COVID recession, crude oil fell to more than $40 a barrel at its lowest point. The price of USO was not nearly managed to keep up with the relative gains of crude itself. This means that when you're looking at futures investment ETFs, it could either be extremely overvalued when the market is high, but it can also be extremely undervalued when the market is low. And basically what this means is it is quite detached from the actual price of Bitcoin, and it can lead to Bitcoin soaring but you not making any money, or Bitcoin crashing and the stock not crashing with it. And it kind of splits itself away from the actual price of Bitcoin because you're looking at future prices rather than the current spot price of Bitcoin. And that is a significant problem with the way the ETFs are structured right now. So just some final words before we finish. So I'll leave you with a quote from David Deerking. So if you want to add Bitcoin to your portfolio, do so. But if you want a second order derivative of the price, buy bito. So although it has its flaws, there are some definite benefits with investing in Bitcoin ETFs. And while it is not perfect, I do believe it is a step in the right direction. And will hopefully sooner or later we can see ETFs actually holding Bitcoin. And who knows, maybe in a year or two, we can see ETFs hold both stocks and Bitcoin. Until then, however, until ETFs can actually buy Bitcoin, buying Bitcoin is a lot more efficient and productive than buying Bitcoin futures through ETFs. This brings me to the end of the video. I do hope you found it beneficial and informative. If you do have any questions, let me know in the comments and I will try my best to answer your questions. And if you made it all the way to the end of this video, thanks for watching and I'll see you in the next one. Bye.